we have a real buffet treat for you this morning. A smorgasbord of trustee company talent. Or I did think about possibly a game show with contestants that will here to answer your questions to win prizes, yet to be announced. My name is Jeremy Muir. I'm a partner at Minter Allison Rudd Watts, and I will be your MC for this morning. So some housekeeping matters. In terms of questions, because we're a small group, if you have any questions, we're happy to take them from the floor, so just put up your hand, I'll keep an eye out. We're going to talk about some specific topics, so you may want to wait until the topic's kind of been introduced and one of our leaders here has talked about it for a bit, and then there'll be probably a natural break where questions might seem sensible, and I will ask. So, our guests here today, we have, I do know who they are, I'm just looking for any important details. Glenys Talivai. Glenys joined Public Trust as CEO on 18 March 2019. A date famous in history is the date where Glenys joined Public Trust as CEO. She is a highly regarded executive with a significant leadership experience in the financial services sector. She also served as Deputy Chair at the New Zealand Institute of Management and was the winner of the Young Executive of the Year at the Deloitte Top 200 Awards in 2012. Matthew Band. Matt was appointed General Manager in 2018, not very specific date on your website, but that's all right. Having joined Corporate Trustee Services team in Auckland in January 2005, he has over 25 years experience in financial services, including banking, treasury, fund admin and operations, both in New Zealand and the UK. Your key strengths are in operations, management, strategy, people management, leadership, all good important stuff, and likes long walks on the beaches. Harry Koprivcic. Harry became the General Manager for Corporate Trusts in August 2019, New Zealand Guardian Trust, and was appointed CEO in August 2020. Joined Guardian Trust in 2005 and has a strong background in financial analysis. So today we're going to talk about 4 key topics, and we'll be introduced by one of us with a short few comments. Then we anticipate a general chit-chat, and as mentioned, if you do have any questions, you have a great opportunity to ask for some feedback from our people here. So the 4 topics that we're going to talk about today are hardship, responsible investing, illiquid assets, including crypto and stress testing, and wholesale unregulated markets. Sorry, trying to read from my phone. I did try to print out my notes last night at the moment where our entire office Wi-Fi went down, thus meaning it could not connect to the printers. Okay, so let's start and talk about hardship. Good cheery topic to start with. So, Matt, would you like to make some initial comments?
Sure, thanks, Jeremy, and good morning, everyone. Great to see a nice turnout at this early time of the morning. To start with, I just wanted to give a general overview of the sort of the hardship process, the qualifying criteria, a little bit about the applications, and then some of the industry initiatives that are going on to address some of the core issues that we're seeing. So, there's a general misunderstanding amongst KiwiSaver members of how the process works around significant financial hardship and what it's there for. Remembering that it's a long-term savings vehicle, there's an expectation from members that they can just pitch up at any time and ask for their money out, but it's not actually the way it works, and it's important that is made clear to the members when they join the scheme. So, as we know, there's some really strict rules around withdrawals and what the funds can be used for. Under the KiwiSaver scheme rules, there's 7 criteria under which financial hardship withdrawals can be made. What we're seeing generally is that most of these come under 3 particular categories. One is the ability to meet minimum living expenses. One's the inability to meet mortgage repayments on a person's principal home, and the other is a member suffering from from serious illness. The most popular of these that we're seeing is obviously the meeting the minimum living expenses criteria. Significant financial hardship means different things to different people. It really depends on which end of the socio-economic spectrum that you sit as to what financial hardship might mean for you. We have seen some real serious cases of financial hardship where people are really struggling day to day to meet their living expenses. But at the opposite end of the spectrum, if you can't meet your payments on your holiday home, or you can't afford your kids' fees for their private school, that doesn't really qualify as significant financial hardship, but we are seeing people making applications for those types of withdrawals. From a supervisor's perspective, we need to be reasonably satisfied that a member is suffering or is likely to suffer from significant financial hardship. The number of applications that we've seen has stabilised. There was an article in the Herald last week where Glenys was quoted around the number of applications that we're seeing now. They've fallen down from a peak of 22-odd thousand at the end of June 2021 to now around 16,000. So that's now that COVID peak's come off. We're seeing a lot less applications coming through. Just from some statistics that we got from the Financial Markets Authority a couple of weeks ago, supervisor approving 93% of applications. Despite this, we are seeing a greater number of complaints from members around declined applications. Some of these complaints are actually also being escalated to the dispute resolution services as well. From an industry perspective, the supervisors are really keen to make sure that there's consistency in the process across the three supervisors who are required to approve the financial hardship withdrawals. The members are part of the Financial Services Council KiwiSaver Early Withdrawals Working Group, and we engage with our clients, larger clients, on a regular basis to ensure that they're keeping up with some of the processes that we've got around financial hardship, the concerns we're seeing and issues, and any of the, particularly the complaints that we might be seeing. Just on some industry issues as well that are being discussed between MB and the KiwiSaver providers out trying to improve their process. As you'll know, the applications are very long, they're complicated, they require a lot of information, and there's a lot of and supporting documents, and there's a lot of double handling of those applications as well, going backwards and forwards between the providers, the supervisors, and also the members. That takes a toll on the members, and also particularly the frontline staff that are dealing with those members, because if you are in a significant financial hardship position and you want your money out quickly, that long drawn-out process takes a toll on you. And applicants, as I said earlier, not really understanding what the eligibility criteria is as well. So some of the solutions that are being looked at are simplifying the forms and making sure there's standardised key messaging to the market on the purpose and the application process and eligibility. Also, there is a workplace savings guideline that's been developed for supervisors to use. This has been reviewed just recently, and an updated version of this will be published shortly. As I said, really trying to get a greater consistency in the process as well. And there has been discussion in the industry around having what they're calling financial mentors or budget advisors as we know it, just to try and help people budget, really not from an initial perspective, but if they're having to come back time and time again and we are seeing repeat applications, just trying to put some structure around the financial position for those members to try and help them manage their finances better. There's a cost to that, and the budgeting service capacity is also an issue which needs to be looked at. That's probably the sort of things that I've got down, Jeremy. Nothing more there that I think needs to be.
Yeah, thanks, Matt. I think that's a great introduction to the issue. I'll open it up to start with. Does anyone have any comment or thoughts from the floor that they would like the panel to consider? No, it's early on, so we can let you warm up a little if you like first. Okay. So I was going to ask, in relation to, obviously this is a topic where it's very important to get a consensus across the supervisors as the parties that have the key responsibility. Do you think you have enough avenues for sort of building that consensus, and is it through things like obviously the FSC, Trustee Companies Association, and any other discussions? So Matt, do you want to? Yeah. Why don't you open up?
Yeah, no, I do believe, as I said, there's regular communication between the supervisors to make sure that there is some consistency in that process. I think it's important that there is that consistency there. We don't want to. We've seen things in the media recently about certain types of withdrawals that have been declined. You don't want someone coming to trustee executives, for example, and getting declined, but then moving providers, then going to Guardian Trust and getting that same application approved. So I think with the workplace savings guidelines, with the interaction between the supervisors and being members of that Financial Services Council working group, I think we do get some consistency
Harry, did you have a thought?
Yeah, I was just going to add, I think over time, as KiwiSaver was developing and we were facing different challenges and different specific cases through CTA, or what's relabeled TCA, this Trustee Corporation Association, supervisors have interacted and on cases where the specific advice was required, this advice was obtained and shared amongst the other supervisors to ensure if there is a unusual withdrawal with unusual circumstances that we have proper advice and is shared amongst the supervisors as well.
It's excellent. Glenys, do you have any thoughts on that?
The only thing that I'd add is as hardship withdrawals, and I think the process has matured, there are some interesting learnings, and we do see a lot of people that make multiple hardship withdrawals because their situation hasn't changed. And so there are some other things that I think KiwiSaver providers are doing. One of our clients has partnered with another company to just help at the beginning of the process around looking at budget advice, fixing debt and the like. And I think that's something that as an industry, it's now about what insights are we getting. I'm not concerned about consistency between us. I think that the guidelines are really clear. We've done a lot of collaboration. We'll keep working on it. We talk all the time, share advice like Harry said, but it is actually now around how do we get the insights that might help Kiwis to not have to access their KiwiSaver in the first place, and actually how do we have think about what's happening for them when they get to that point that there might be an earlier intervention, I think is an opportunity.
Can I just add something
Yes.
further to that, Jeremy, as well? We had an instance once where a complaint had gone down to the Financial Services Council, and there was a lot of debate around whether it should have been declined or should have been approved. What the Financial Services Council was actually gave that information and that application to one of the other supervisors to test what that decision was, and this decision came out the same as what the original decision to decline that application was as well. So there was that mechanism as well.
Yeah.
You can have it peer reviewed technically by one of the other supervisors as well.
Yeah, that's a great safeguard. Actually, Glenys, one of the things you raised there is interesting, which is the initiative by a KiwiSaver provider. Do you think KiwiSaver providers have a role, or is there more that they could do in terms of supporting their customers in terms of when they make hardship applications or avoiding getting in that circumstance?
Look, I absolutely think even from just a good customer outcome and conduct perspective, KiwiSaver providers can always be thinking about the advice that they're giving to investors, and it's also in their interests if investors aren't accessing their KiwiSaver funds too early, and obviously is in the best interest of the investor. So I just think that as we mature through KiwiSaver, and whilst it feels like we've had it for a wee while now, it's not in relative terms not that long. So what are we able to glean? I mean, it has been difficult. It's been a difficult couple of years, and people have needed to withdraw from KiwiSaver for genuine hardship reasons. But it's actually how do we help those people to make sure that they don't get in the same position again? Because unfortunately, we do see a large percentage of applicants applying more than once.
And Harry or Matt, do you have any thoughts on things that either KiwiSaver providers could be doing or other parties such as the media or FMA in terms of talking to the public?
Yeah, I think there is that, as Glenn has said, the financial hardship is almost an ambulance at the bottom of the cliff, and I think, what we want to do, get at the top of that cliff and try to prevent those kind of outcomes in the first place. And obviously the providers themselves, they have a role to play, in particular those default ones, in terms of engaging with the clients and educating about investing and financial products. But I think there is a wider role to be played by other institutions, banks and other entities that are actually engaging in providing funding or loans or to those investors that might not be able to actually financially support themselves for a long period of time and then get in financial difficulty. So role of financial advisors, role of budget advisors, but that has to be, I think when it comes to hardship, that's already at the bottom of the cliff. It has to be done well before that. It has to be at a time when the loan was taken from the bank or from other financial institution.
I do think that as supervisors, recognising that when someone's gotten to the point where they need to make a hardship withdrawal from their KiwiSaver and to Matt's point earlier, the process and the application is quite lengthy. It's quite detailed because it is, there are specific guidelines that need to be met. But I do think that supervisors have worked really hard to make sure that those applications are addressed as quickly as possible and turned around as quickly as possible, recognising that those people are already in some stress and are doing it tough. And so how we can minimise that if it's a genuine request, I think, is something else that supervisors have been really focused on.
Yeah, and I think it's important to try and stop the repeat applications as well in some way, shape or form. So, being aware that someone's made an initial application and then trying to do something to help them get out of that position long term, not so they're coming back again in, 3-6 months, whatever the case may be.
Yes, thanks. Matt, to pick up on one of your earlier comments, have you, between you, seen examples of people who have been sort of forum shopping in terms of changing their KiwiSaver and then thinking that they can apply for hardship somewhere else?
I've heard rumours, but I haven't.
Apocryphal
but I haven't
reports.
Heard anything concrete. But
Yep.
Look, that is an option, and that has been considered by some people. If you don't approve my application, I'll move schemes and go to another supervisor and things like that.
I'll be honest, I don't think that many consumers would actually even understand the process and behind it to know to do that. But some, obviously, you could never say never. There's none that I'm aware of, but many don't know even the involvement of supervisors in that particular part of their process behind their KiwiSaver provider.
That's right.
And a lot of that comes down to the education, in the market, and as I mentioned before, making sure that members are aware that it's a long-term saving, what the process is. It's very hard to get your money out. Don't just think you can come along and fill out the application form and you're going to get your money handed over to you. And most of the time people want all of the money in their scheme, but they don't necessarily need all of the money. If they've got $10,000 in there, they want $10,000. They may only need $3 to relieve their, financial hardship position, but they still want all of it.
That's right, and bearing in mind that we're trying to preserve people's savings for retirement as well, clearly. So that's a great discussion on the topic. Do we have any questions or thoughts from the audience? Yes.
So I'm Trustee CEO of Netflix, and I believe I mentioned
Wonderful.
personally involved with the I come from the budgeting sector, I've been nearly for 18 years. I'm also a tutor for ThinkCap, so I train people to become financial mentors as well. And one of the things we say is, will KiwiSaver withdrawal make a difference? And if it won't make a difference, then we need to look elsewhere. But what we can do in the sector as well, in my sector, the budgeting sector, is look at other avenues for them before they withdraw their KiwiSaver. So it is great to connect with us and collaborate with us. I've got capacity.
Okay, we'll keep you in mind then, Christine. It's interesting.
One for the managers in the audience too.
It's an interesting point you make there, because we do see a lot of people coming to us wanting to withdraw money to repay, GE, GEM credits or buy now, pay later or credit cards and that sort of thing. And that doesn't fall into financial hardship. And just going to your point about whether KiwiSaver is going to make a difference, for those people, you can't get your money out for that purpose, because you're only repaying a credit facility which you can then draw back on. So you're not actually going to put yourself necessarily in a better position long term. So good to know you've got some capacity there.
Yeah, and just to add to that, I think to your point, it is because the way the guidance works and how much can be released, it is on a shortfall, and there's only a certain amount of months or weeks that you get out. And unless there is a help in changing behavior or trying to change anything other than the hardship withdrawal is only going to fix the problem for a short period of time. It's not going to fix it long term.
Thank you for your contribution. That's very helpful. Any other thoughts from the audience? Okay, well, another hot topic of the day is responsible investment. Harry, would you like to give us some thoughts as starters for 10?
Thank you, Jeremy. Responsible investing, I think there's a lot of topics, there's a lot of discussions, different session around that. But we'll cover it just around from the point of what the supervisors have been doing, what we have been doing, and also what FMA has been doing with their recent thematic around integrated financial products. As you're all aware, the FMA has published guidance on disclosure framework for integrated financial products, and those include two types of the securities, which is the debt securities and managed investment schemes. And the guidance highlights that importance of incorporating non-financial factors need to have further explanations for investors to ensure that the features of those products and offer are fully explained to investors and to avoid greenwashing. And while the guidance focuses on disclosure aspects of the financial products, it also emphasizes the need for managers to substantiate ESG statements that they make. The guidance provides the framework and that FMA expects issuers to clearly explain the purpose of the offer, what is the money used for, what is the justification for labeling, what is the actual product going to try to achieve, measurement, is there a measurement of the non-financial performance, governance framework, there has to be a strong governance framework around that, internal audit or any other assurance explanations that are included within an offer and how those are dealt with, and risk associated and cost associated with the integrated financial products. And also, obviously, the consequences of failure and what happens if the product is no longer meets those criteria. Many of you might be aware, FMA has undertaken a thematic review of managed investment scheme offering for integrated financial products. They've selected schemes and funds that use the words in their name in terms of sustainable or responsible investing. The findings have been communicated to each manager, and the manager has provided feedback on that. And following that thematic, FMA has published a report on what areas they see that need to be improved in terms of disclosure and offering on integrated financial products. And essentially, those includes that FMA has highlighted there was, as a result of their thematic, their findings were that there was a lack of sufficient detail included in documents. In some instances, there was no clear delineation of the lines between financial and non-financial factors. FMA expected more clear explanations around exclusion and selection process. Managers could have provided a better information to help investors understand the risks associated. Consequences of breaches were not clearly explained and articulated to investors. And also the references to external providers. A lot of managers do reference external providers that are party to certain standards. But it was really tying that, what does that mean for the investors when you start referencing. Following publishing of that report and the thematic, I think the industry and the managers have acknowledged some of the challenges with FMA's expectation, because as you might be aware that there are certain strict restrictions and rules, how word counts around PDS and SIPO, and making clear that the other aspects are still contained and clearly explained. So I think industry is going to, and the managers, some of them are facing a bit of a challenges on how they can incorporate a lot more detail what was requested of FMA in some of those documents. And I think there could be a bit more work and explanation from FMA side on explaining how to clearly link those policies and procedures and the detail that it might not be able to be included in PDS or SIPO to a certain extent. Following in line when the actual guidance came out in expectation, we started to undertake a thematic review. And whilst the FMA's thematic review was more around disclosure aspects, we wanted to understand what controls and processes the entities have to ensure that they can comply with what they're actually saying to investors that they are doing, and that the statements can be substantiated. So our review was more focusing not so much around disclosure, but this is what you are saying, can you substantiate that? General findings from that thematic are that in relation to hard exclusions, certain industries that they're not going to invest in, managers have had robust controls in place, pre-trade, post-trade checks. So hard exclusions are quite easily dealt with, and there are good processes and controls to ensure that these products are not included. It gets a bit more trickier when it gets to soft exclusions, and these are the sense that when if you have statements that to sensitive sectors and certain exceptions around the policies, and when you might take a view on certain industry, but if it meets certain criteria, then you might keep it for that investment for a while. Our findings that policies, general policies that managers have, could be clearer, or how these are reviewed and monitored, those soft exclusions, and also in what instances, when there's a non-compliance, in what instances with entities look to exit those offers, and for how long they will actually be prepared to live with some of those exclusions, because essentially some of them are short-term as well. For example, we will invest with an entity if it meets these criteria and gets, but expected to meet certain criteria within a certain time frame. What happens when the time frame was not met? Probably the most difficult one for managers to substantiate from our finding was around claims where the managers claim that they have active ownership, and this is obviously when managers are investing in entities, and managers claim that they will use their positions as a shareholder to encourage and support companies to do better and be good. I think overall the industry could do better there. Managers should have clear engagement policies in place. We found that not all managers have that in terms of how often are they engaging with that entity, what are the discussions that are taking place, and also documenting those and making sure that there are clear records in place that they can demonstrate how those engagements have taken in place. And also, it is difficult as well to a lot. If they make statements like that they could do better, a lot of times they're only a small shareholder as well. So how much difference they can actually make, it is very questionable in some circumstances as well. Outsource providers, again, one area that we look at where you have an underlying investment managers and the manager is making statements in their offer documents, but underlying investment managers have their policies around investment. We found that there could be a more clear alignment of those policies sometimes. I think managers have to be careful if underlying managers might take some changes to those policies or exclude them, that their policies are updated, that the policies are not misaligned as well. And I think there could be we found that there could be a closer oversight of those underlying managers to ensure that they are complying with their policies as well. Statements, just quarterly statements or something that they've complied might not be sufficient in certain instances as well. And the other area that we looked at as well was consequences of non-compliance, and this is what I mentioned earlier. What are the policies and how the manager has clear guidance as what they will do if the entity is not complying, or in relation to active ownership, if they are not making any difference, if they're investing in that entity for a year, 2 years, they are not seeing progress, their policies could be clearer around what the manager will do in those instances as well. And that also includes not just active ownership, but also those soft exclusions, as I mentioned earlier.
Thanks, Harry. It's obviously an art as much of a science for the supervisors to supervise managers in relation to some of those soft exclusions, and obviously things like active ownership. Matt or Glenys, do you have anything you'd like to add to that?
I don't have anything particular to add. I was interested if people had questions or what they're thinking about in terms of their own, I don't know how many fund managers there are in here, about their own processes, or how they're thinking about some of the key challenges or themes that Harry talked about.
Any comments from the floor? Okay, Matt, do you
I think it's probably helpful for the industry that the FMA has put out the guidance. I think we saw some managers probably got a little bit overzealous with what they were trying to do from a responsible investing perspective or a green perspective. And it was probably fair that things just needed to be pulled back a little bit. And then now the FMA has given some clear guidance on sort of what they need to be looking at. I mean, Harry made the point about the disclosure documents. I mean, first and foremost, it's an investment product, so you need to make sure you're getting the investment product detail into your PDS, and then the other bits go around the outside. But we are limited by word numbers. Oh, sorry, by number wording limits.
I was just going to add, Jeremy, that this is an area. So I think about it from an investor-consumer perspective. So more and more, there's a lot of noise in the atmosphere around doing good, ESG and the like. So I think there is definitely a group of investors out there that are looking for funds that are going to help them to feel like they're contributing, which is why the disclosure is so important, because investors are relying on that fund managers are really clear so that they can make informed decisions around that. And it's becoming more and more relevant. And we're on a journey, and I think that that's only going to accelerate, or there'll be more investors that are looking for opportunities for these types of investments. And so, again, providers, supervisors will help providers to make sure that they're really thinking about what it is that they're doing and how they can substantiate it.
Yeah, to in part give a manager's perspective, having been through one of these processes with a manager recently where they did receive some feedback from the FMA in relation to the claims and statements in an offer a brand new offer document. A lot of what they were concerned about was in relation to the issue of, well, if we speak in more specificity about some of these, the things that we would like to do and the things we would like to achieve, how will we be held to account against our words? And really, all we can say as lawyers is it's not that different an issue from the promises or the intentions that you state in relation to any other aspect of your business. You just need to be clear in your disclosure documents as in, what are targets, what are aspirations, and more so what in fact you do, and then ensuring that in fact you do that. So any other last comments from the floor or thoughts? Yes, Fania.
Thinking about the fact that in the conversations that I've been part of, one of the managers really have been through the process times has been a public manager. So I think then, because it's such a fast evolving area, it's great to see that we've been able to come into it and someone will tell us what we're doing, and so far it's quite a
Absolutely, my experience too.
I think the initial process around just writing to them and saying, you would picked up these things, you need to fix them, is the right approach, as opposed to the whacking them with the big stick to start with. So you're giving them an opportunity to, as I said, to sort of pull back a little bit and then review what you're doing and start again.
Great. Glenys, do you want to talk to us? Sorry, a question of that.
Following the sort of site representing regulation reform, one of them is we put it around the growth of consumer interest in this. In all the surveys that we do, we see phenomenal levels of interest, particularly around young people in this area, and I think that reflected why we got a lot more interest in the space over the last 2 years. People see that that's where consumers were increasingly going, very, very interested. And this probably reflects the fact that I'm not a lawyer, many of the problem of the conversation. There's a lot of discussion around disclosure documents, but I think another key point to think about is what you're saying on the website, because that is what consumers are actually looking at and seeing. And it's sort of heresy to say it, but I'm not sure all consumers are wading through PDSs, but they probably are looking on your website. So,
No, that's a great perspective. And I think it certainly brings out the point that it's not all about the PDS at the end of the day, it's about all of the statements and the wider set of communications to your audience.
Yeah, because a lot of, to your point, a lot of those websites also have links to their policy and things like that. So it is important that, while we have PDS and SIPO and as main kind of offer documents, I think everything around that becomes terms of the offer, and you have to ensure that those statements you need to substantiate, they comply with those.
And in some respects, setting things out appropriately in your SIPO as part of the process of substantiation, perhaps, of the less detailed comments that you may make elsewhere.
Which is probably a good segue into just a bit of a chat around illiquid assets, because there's very similar, I think, thinking and learnings here, and when we talk about disclosure, but also considerations in terms of managers and their funds. So we've definitely seen in recent years an increase in the number of fund managers that are looking to include more private assets as part of their portfolios. I think McKinsey stated it was about a 30% increase for the 12 months to mid-2021. And, whilst these have been used as part of to diversify portfolios for some time, when you're faced in a low interest rate environment, there is equally another group of investors. Some of them might be overlapping with the same group of investors from before that are looking for higher yield in some of these types of assets. And so, whilst again we see that often many of the managed investment scheme managers that we supervise are really well versed in the risks around some of those illiquid assets, that's not necessarily the case for investors. And so there's definitely some key considerations that supervisors really want to reinforce with MIS managers in terms of what we're expecting when it comes to these types of investments. Obviously aside from the risk of failure and the volatility that often comes with these types of assets, inflation and valuation uncertainties are the most prominent risks that we expect MIS managers to carefully consider. And of course, having a larger exposure invested in a portfolio may leave that portfolio unnecessarily exposed to high liquidity and valuation risks if there was an event like the GFC or the beginning of the pandemic again. So some key things to think about because, investors, there are some investors now that wouldn't have experienced the GFC or some of these other events, or particularly investors coming into the market post-pandemic where they may see opportunities. So now why that's important, particularly around liquidity risk, is that if you use an example, and I've just talked about, pre-GFC or around the GFC or at the early stages of the pandemic, is that what we see is a call on funds, so mass redemptions, people looking to switch, and if you have kind of a low amount of illiquid assets or private assets sitting in those funds, but you've liquidated the stuff that you can, all of a sudden the percentage that is held within that fund is a lot bigger than what it was before, which is quite a different risk profile for investors. So from an investor's perspective, again, it's really thinking about, and equally too with the liquid assets, pricing those on any given day is quite difficult. So if I use that same example, if you've got investors coming in and out of a fund, and that's not, it could be that valuation is understated or overstated at any particular time, given the way that those illiquid assets are valued. So from a supervisor's perspective, we're really looking for MIS managers to think about how they are considering those liquidity and valuation risks, and in particular what policies they're putting in place around those private assets. So really looking at things around how much they're holding, what does their policy, determine or guide around that. That's quite important so that those that are governing the manager can be very clear around what is invested, to what degree, and what are the relevant exposures. And then, of course, it's thinking about what are the limits, if they're going to hold or lock in illiquid assets for a certain period of time, and what does that mean for other decisions you might make in the portfolio, how are you going to value them, and how often are you going to value them, and how are you going to escalate, what's your escalation process in event of a breach, and equally to, what are you going to do to consider the suitability of the investors that are investing in your fund in and around that. And, similar to having a policy around your private asset management, it's also around having a liquidity management policy and really thinking about what needs to be a part of that. But also we expect managers to implement tools and levers to effectively manage liquidity, looking at, maybe side pocketing illiquid assets, held in a fund, and most importantly that they're regularly stress testing the fund in terms of liquidity. So, even playing a scenario through historical events to see how that fund would hold up or what would be the impacts of that fund is a really important consideration. Now again, the FMA has issued guidance, relevant guidance in respect of liquidity management. And, to the point that we were talking about, anything around illiquid or private assets really does need to be in SIPOs or carefully considered how that's represented through other communication devices or avenues that managers are using. And most importantly, I think for all of us as supervisors, for managers that might be thinking about illiquid assets or changing their portfolios, as we would encourage them to engage early in a conversation so that we can walk alongside and make sure that all of these things are being carefully considered before there is firm decisions made, because it is about what is the flow on and importantly the disclosure, and that investors understand the risk within the fund and the portfolio, and that you're clearly articulating that and thinking about how you're managing the risk for yourself as well.
Fantastic. Harry, are you loitering to make a comment?
Oh, no, I was just going to, I think Glenys covered that very well. And, it is important for managers, if they start to think to invest in those kind of assets, is that they have they have appropriate skills, processes, governance, and policies in place to do that, because the consequences of can be quite severe. If the fund needs to be suspended, it's unlikely that it will ever be open. If these are the worst case scenario, and then in particular when we go to if you look at the KiwiSaver offering, it becomes a lot more challenging there, because you have you can't side pocket potentially the KiwiSaver because it's transferable. So you can't be party to two different providers at the same time. You also you have issues with withdrawals as well. Potentially, what happens with that? If you have to side pocket or if you have to spend the fund, there's a lot of potential severe consequences if there is no proper policies, procedures, governance, and skill to manage those types of assets.
Great. One of the holographic NFT elephants in the metaverse room in this case would be crypto assets. The England and Wales Law Commission has just published recently a 550-page discourse or discussion on whether crypto assets are property, and proposing a new third category of property of data assets to cover these things. Crypto assets have unique properties and are held in different ways, which obviously when we get to the stage perhaps of retail products holding some of these assets directly as opposed to now maybe through overseas funds, what are the trustee companies doing to sort of upskill or make sure you have the systems, technology and understanding to hold these assets?
Yeah, I think it's actually a key consideration, Jeremy, because we have seen a small number of fund managers come into the space. Certainly some more have been interested. They might not have quite gotten there yet, but there have been a small number that are setting up or launching retail cryptocurrency funds in New Zealand, and at least one's already included it in their diversified funds. I think the key thing here is that it is very volatile, as we've seen, and also too is that they're generally not well understood apart from a crypto specialist. I have to say that includes myself in terms of, there's elements that I understand, but it really is, there are specialist people out there. Now I highlight that because if you're an everyday investor looking to invest in these types of funds, then the understanding is, at best you'd have to assume quite low, and therefore there's probably even more that we need to do, or managers will need to do, to help people to understand what it is they're investing in and what the risks are. There is probably an additional risk in terms of, so still I think the volatility, the valuation, the potential liquidity risks that might emerge from crypto. But if you also think about, these are currencies that are held in the web and online, and whilst they're apparently supposed to be unhackable, there's been certainly some challenge or some piece around that, and I don't know if, I would be really interested to hear from someone if they've got particular knowledge around how certain and secure. I'm sure there's people trying to hack into those all of the time. So that's a really important consideration in terms of custody risk, because when you're not actually holding the physical asset, but it's sitting in this world, is that there is a risk there that all of a sudden that can be hacked and disappeared in terms of that online piece. It's not supposed to be. I don't want to create any scaremongering around it, but it is a risk because there is uncertainty there, and because of, I think, the early stages. And so I think managers really need to think about how they're administering the fund, the custodian of the underlying cryptocurrency assets. Just to make sure that there's really adequate controls in place, and how's that tested, and how's it been held, and how you're reassuring yourself all of the time of the security of those assets, because I think that's it's not necessarily an elevated risk, it's an uncertainty given where we are on this cryptocurrency journey.
Yeah, and what I'd say is, a lawyer who does work in this space quite a bit, there is a great deal of built-in protection in the actual the distributed ledger, the blockchain technology, which does have immutable aspects, but it is around the custody and the other layers that are built, bridges between chains and various other things. That's where things are actually vulnerable to attack. So it actually is that will be reduced over time as good systems and technology and role of independent custodians and things does come into play. So it's a little bit chicken and egg. Matt, do you have any comments on any kind of illiquid assets?
I guess crypto, to me it's a FOMO asset. I don't think a lot of people really understand what it is, but they've just jumped on the bandwagon because everyone was buying it. It was going up considerably, but the opposite of that's happened in the last sort of 6 to 12 months. But I just think people need to be really careful about putting it in portfolios, particularly as KiwiSaver just at the moment. I think it needs to mature a little bit as an asset before it becomes mainstream for it to be really understood and have a place to play in portfolios.
Certainly. Harry?
You might disagree, Joe.
I don't disagree at all.
I think Glenys has covered some of the concerns in terms of volatility. Obviously, custody, big one, obviously, but I think what Matt said is the market needs to mature. It's not well understood assets, and in terms of from the supervisor's point of view as well, it has to be very clearly supervised and monitored for those managers that try to embark, similar to any other asset class, that it's non-vanilla, that it becomes more difficult, and skills associated with holding those or assets or managing those assets, as the whole market can mature a little bit more before you let it wide to investors.
Yeah, I think a softly approach just with illiquid assets generally across the board is probably the best option. Listening to one of the investment management panel discussions yesterday, there was a sort of brief discussion on liquid assets, and it's it starts small and then just sort of monitor it. But as Glenys already talked about, you need to make sure that you've got the belts and braces around those illiquid assets to make sure that they don't get away with you in certain events.
I mean, again, there are investors out there that are looking for opportunities to invest in such funds. So it's on the managers need to carefully consider how are they disclosing the risk, making it very clear what it is that investors are investing in, and then from a supervisory perspective, we want to make sure that they've got to the point the belts and braces in place. That's really managing that risk well.
And I think it's clearly a spectrum, isn't it, between speculative new cryptographic assets at one end, which Andreessen Horowitz, world's largest, one of the venture capital firms, thinks that in terms of crypto assets we're at about sort of maybe year 7 or 8 of a 30 to 40 year evolution. So there's still a lot of water to go under that bridge. But then further along the spectrum, you have more well understood assets. So it's good to see, with another of my hats on, KiwiSaver money, for example, going into private markets like venture capital and private equity, and there's a lot more history and understanding around those assets. But they are still illiquid, so raise some different issues. Any thoughts from the audience? Alistair. Matt.
Yeah, I think when property funds are being launched, there's a fairly clear explanation that it's a long-term investment. Generally, you're getting into a property syndication offer. It's 10 years. The funds are leveraged up to 50%, so there is a bit of buffer there from a valuation perspective. But again, I think it comes down to disclosure and investors understanding what it is they're actually getting into. I know New Zealand has a love affair for property, and as you say, it doesn't always go up. But I think as long as people understand what they're getting into, it's a long-term investment, and you're happy to or able to ride out that time frame, then I don't see a particular issue with it.
Yeah, and certainly property funds, looking back to sort of 2008, there were a number of stresses that came on both retail and wholesale property funds in that market, particularly where there were development elements involved as well. So if you have finance and credit drying up effectively, you can get into some quite sticky situations. So.
I think it's the development sector that's the issue, not the asset holding sector. And that probably is a good segue, Jeremy,
into the next topic. It's a fantastic segue, Matt, into our next topic, which is wholesale, the wholesale sector generally. So I'm just going to make a couple of initial comments, but I won't. I'll leave the air to these people. So clearly, wholesale assets have come under the scrutiny recently of the Financial Markets Authority. If you look at their statement of work, effectively, their corporate plan for the next couple of years, they are in the midst of a thematic review of the wholesale markets. We have seen a number of managers, particularly, it's quite tied into the property sector at the moment, or property investment, but it is not exclusively that. We have also seen some interest in wholesale DIMs and other types of arrangements as well. And if you look at particularly what the FMA came out with in relation to Duval, obviously a property manager who offered and regularly advertises, as many of you will no doubt see on the internet, a number of relatively high return offers, and they are all clearly expressed to be available only to wholesale investors. But the direction order issued by the FMA in relation to some of their advertising, which was then challenged in the High Court, but the position of the FMA was largely held up in relation to, is there a different set of approaches that the fair and misleading type of tests have to apply to the wholesale as to the retail sector? I don't think either the court or the FMA gives much credence to that argument. But one of the key points was, although as a lawyer I can tell you it's absolutely legally possible to advertise a wholesale offer to the widest possible audience, what the law says is that you must then ensure that only wholesale people actually, at least in a Part 3 of the FMCA context, only wholesale people actually subscribe. Clearly there is a I think, very valid concern that if you spread the drift net wider into the seas in order to catch as many fish as possible, you then run the risk of people who are not sophisticated self-certifying themselves as wholesale, or possibly meeting some of the other large sort of wholesale tests, but really not understanding the types of investments they're getting into. So in that wholesale sector, when you make offers of financial products, even if it's, say, a wholesale managed investment scheme, you're not required to have the scheme registered, which means you're not required to have independent supervision. But I think in many cases, people recognise, or there may be a role for the supervisors. So I'd be very interested in the thoughts of the panel as to what you see the potential and actual role of supervisors in the wholesale sector. Matt is the one closest to me.
Thanks, Jeremy.
In the hot seat.
I do have a real issue with these wholesale offers, and to me, it's there's three issues that I guess you could call are loopholes in the current structure environment. One is that the wholesale offers we're seeing are deemed to be wholesale offers, but the investment amounts that they're seeking from investors are at a retail level. You've got, is it investment managers just looking for an opportunity to skirt around the MIS licensing requirements and just calling it a wholesale offer, but attracting retail investors, and the self-certification issue, where you're certifying that you're a wholesale investor when really you're not, is another issue that has to be tidied up. We've heard of an instance where someone certified that they were an institutional or a sophisticated investor because they were investing in KiwiSaver, and they've used that as an opportunity to get into a wholesale offer. But I just question whether people really understand what they're getting into. I mean, Glenys made the point earlier about chasing yield, and we're back to finance company days where these wholesale unregulated offers, particularly in property development, are offering 10% in the current environment. That's very attractive to a lot of investors, but understanding what you're getting into is a big part of it. But I think as I said, there's probably 2 or 3 loopholes there that really need to be tidied up around that space, and I'm pleased to see the FMA are taking an interest in it.
Yeah, as lawyers, often when we act for people undertaking wholesale offers, we may prepare forms of certificate, safe harbour eligible investor certificates. Often we don't actually see how they are completed, but I have done one exercise in the last year or so where a very sort of compliance-oriented manager asked us to review every certificate that they received, and you're right, actually what people write in those certificates is often not what a manager should be relying on. So there is a lot of people try through FOMO or other things, just trying to access those returns by sneaking in. Harry.
I was just going to add, I think it's also the offers and in terms of what was disclosed, but also the management behind it and how they are structured. And we are aware a lot of them are structured that if the market moves the wrong way, they're structured in such a way that they're going to run in difficulty. And the problem with that is that you have a flow-on effect on actual regulated market and regulated providers that are supervised, because investors might not understand the differences, and the flow-on effect with media will be substantial. As Matt said, FMA is undertaking a deep dive into that sector now and will publish a report. But I also understand FMA has certain powers to deem products to be regulated. I'm not sure I would be putting my hand up to supervise any of those, but I'm not sure. I would ask FMA not to use those powers and use other powers.
And clearly the FMA also is capable and does use its broader powers under Part 2 fair dealing in relation to it's relatively easy often to find things which might be misleading or unsubstantiated. Glenys, any
Look,
thoughts?
I didn't really have much to add. I think Matt and Harry have covered off the main points, just both in terms of what we see are the investors really wholesale investors? And this is high risk. I think it is. It's very dependent on the people behind the offer, and it's making sure that investors know what they're getting into. And so, I think your question was, is there a role for us? But I think Harry was very good at kind of insinuating where we would sit on that at this particular point in time.
Can I just make a fourth point about a fourth loophole, Jeremy? Is the use of a company structure instead of a licensing or a managed investment team structure. We saw the Nido investment a few years ago, which was run by an outfit who I won't name, but who were not licensed, so they were using a company structure, no supervisor, no custodian. So, I mean, to Alistair's point, as long as you've got the right structure around that property investment, I guess is important as well. So,
Richard.
I think one of the key roles of supervisors here is as gatekeeper, because a number of these wholesale outlets would come to us, in fact all of us, and ask us to be supervised or later set it off. And then we get around that information in the supermarket anyway.
Dan, for example, with Nido, they also went around the licensed managers for development, and they also know credit development risk, financing risk, and the industry risk. Just one of those things should not have a lot of input, and people are also something a lot of these other ones that are offering high rates, very similar statements, very high risk in the market that are very performing.
You heard it here first, and probably regularly afterwards as well.
I don't think those people are in the room.
That's certainly
Richard.
possible. Do we have any wider questions? We have a few minutes before we need to wrap up that anyone would like to ask this wonderful panel. Okay, perhaps any final thoughts? Words of wisdom? What I did in my holidays?
Make sure you engage with your supervisor.
Nice. See what I did here.
Agree with Matt. early engagement, very important. No matter what we're talking about, when it's or these topics, or value for money, which is another topic. But yeah.
Yes.
Yeah,
You're going to have to stay here for another half an hour while we also talk about value for money.
You need to go to Harry's session at 1:30 for that. Is that I think following on from the engage early is that there is a lot to consider and a lot of option out there for investors at the moment, and so making sure that they have the best possible information, that they're clear about the risks, and that we're thinking about what those risks are, not only at the investors' end, but also what's happening in and around the fund. There's a lot to consider. So when we say engage early, it's actually, the kōrero is really important because ultimately, particularly for managers that are trying to, think about how they become successful, how they strengthen their performance and their business and attract more investors, is that supervisors can play a really important role in helping managers to achieve that outcome and making sure that investors are considered through that, as managers are genuinely trying to do too most of the time. So I think that's the important role that we play in terms of with our clients.
It's undoubtedly right. It only remains for me to ask you to thank our panel in the usual way.